you have to ensure that you're supporting the top quartile managers. And so, one of the things that, when you're taking a look at established versus emerging managers, a lot of the, decision making is, quantitative versus qualitative data. And so when there are times of uncertainty, you're just going to, lean back to, more proven track records. And so the GPs that have that quantitative data, there is data out there to show that if you have a GP that is a top quartile performer, they're likely to be persistence in that performance going forward above median. And so you have a little bit better comfort there. On emerging manager basis, there is a chance for outperformance, but there is a chance for underperformance as well. You have a greater volatility of return there. So how do you meet enough emerging managers to ensure that you're selecting the top GPs?
Hey everyone, this is Prashant and I'll be host for the VC10X podcast. And today we have Tony Meadows with us. Tony is a partner at Sinefine, an investment platform backing female-led co-led VC firms. Before joining Sinefine, Tony held the position of portfolio manager of a $70 billion pension fund called Pennsylvania Public School Employees Retirement System, or PSERS in short. His responsibilities included overseeing a mature portfolio of private equity investments and participating in advisory board meetings. In this episode, Tony shares his story of transitioning from managing an institutional fund to Sinefine, where he's backing female GPs. How do big LPs think about the venture capital asset class? How can GPs build relationships with institutional LPs? How much percentage allocation does venture capital get from an institutional fund? Why do institutional LPs prefer to invest in brand name funds? Why consistency is very important for LPs deploying into VC asset class? And lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast10X, where I help VCs start and run their own podcast. While I was running VC10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Tony, so good to have you on the VC10X podcast. How are you doing?
Great, Prashant. Thanks for having me.
It's a pleasure having you on. To start things off, can we have your story and your investment journey?
Sure. I started my career as a CPA, and when I began at PSERS, I started in the financial management office. I eventually worked my way up to what can be thought of as a controller position, reporting directly to the CFO, responsible for the public market accounting and reporting, the contributions of more than 500 school districts and entities that belong to PSERS. At the time, it was roughly $3 to $4 billion annually, and I oversaw the general ledger and financial reporting. From there, I transitioned over to the investment office. I started as an analyst there, supporting the portfolio managers in private equity, private credit, real estate, infrastructure, absolute return. It was more of an operational role. That's where I began underwriting co-investments for all these strategies, and first as an assistant and then leading co-investments later on my own. I then began to specialize in private equity. That's where I became a portfolio manager. Primary responsibilities there were sourcing, underwriting, recommending primary fund commitments, as well as monitoring the current portfolio that I was responsible for. PSERS had LPAC seats on nearly all the investments, so I actively participated in LPACs for all the relationships I was responsible for. In total, from a sourcing or recommending standpoint, in total, I helped PSERS commit more than $2 billion in primary fund commitments and co-investments.
Absolutely, that's very interesting. And just a follow up question to your answer, how's it like being on the LPAC, and what are the key responsibilities there?
Um, yeah, being on LPAC, it was certainly interesting. Every GP is different, and how they conduct LPACs, and certainly be able to get you know a little bit more informed view on some things was helpful. There were certainly some GPs that um, there might have been a lot of consent that you had to participate in, and then others, very little as far as consents go. And those, when I say consents, are more from a conflict of interest standpoint, and it's certainly not investment um, related in the sense that we're not saying it's a good or bad investment. It's just opining on whether there's a conflict of interest. So it's certainly helpful to see the dynamics and how GPs operate from that standpoint as well, and how they view conflicts and things of that nature, and being able to help make recommendations on what kind of reporting would be useful to the LP community in general, and certainly the LPs that belong to that, um, that were participating in that fund. Um, so yeah, I mean, it was certainly a helpful experience to have.
Absolutely. And so you left PSERS and now you're working at Sinefine. So tell us what motivated you to leave PSERS, which was an incredible job in itself, and why you joined Sinefine.
Yeah, my time at PSERS was extremely valuable. With any job, you have positive and negative experiences, and they certainly help shape who I am today. So I'm extremely grateful for the opportunity. In short, Cine Fine's founder, Yasmin Lakalade, started something that I saw value in, and wanted to join. I wanted to be able to make a greater impact in the GP community that I could at a large organization. Um, in doing so, I would be able to help commit and support GPs that are typically difficult for large organizations to access directly. In many ways, women-led and co-led GPs are underappreciated, overlooked. I believe there's alpha to be gained in investing in many of these firms. Many GPs want to commit to these firms, but when GPs don't resemble the norm, how do you normalize that group? Um, what I believe is that you should cover the entire market, make it your norm. Meet every GP, be open to different avenues that allow their strategy to succeed, and invest and support the very best. The prospect of building something unique at the end of the day is a very attractive proposition, and I'm extremely thankful for the opportunity.
So that's very interesting. And can you help us contrast how's it like uh, investing as an institutional investor, and that's a very large fund that is investing into multiple different asset classes, and some part of the allocation, maybe a very small part of the allocation goes to VC, and then now working for a fund that is investing into emerging and established funds, female led or co-led funds, right? So tell us how these two are different and what do you like better.
When you're working at a large institution, that your primary goal is to generate returns for the membership, um, and be able to pay out distributions, and you certainly have a target return you're trying to achieve. Um, but you're a generalist at many of these larger funds, meaning I worked in VC all the way through buyout, and they could be drastically different. So if you were to splice VC and you were to splice buyout, um, you would certainly take a look at different opportunity sets, whether they're from a VC side looking at smaller GPs that are looking at early stage investments, and then on the buyout side, you would have the equivalent of small cap. They're buying companies that have less than or $15 million of EBITDA typically, and then on both sides, they both can be a larger scale all the way up through growth equity on the VC side, and then on buyout, having mega buyouts, and taking maybe doing take privates and things of that nature. So at the end of the day, you know, you're really trying to generate alpha over public markets, and you're doing peer group analysis to make sure that you're selecting top quartile managers. At a large organization where you're responsible for VC through buyout, you have to really analyze your bandwidth and determine exactly where you're going to spend most of your time. VC as an asset class for institutional investors are generally a small segment of private equity in general if it's grouped with private equity. So it may only be say 15% of total private equity allocation. That's similar to what we were looking at PSERS at the time. And so um, it's a little bit more difficult to cover the market, again, VC through buyout, whereas with Sinefine, we're specializing. We're specializing in VC, and even then, we're specializing in women-led and co-led firms. So, there are many thoughts of specialists versus generalists across the board. I think there's value in both, but we're definitely going to be a specialist in women-led and co-led firms. And if we know that market inside and out, I do believe that we can generate outsized returns. And so it's a little bit, it's tough to compare the two to say, it's neither here nor there, because you can certainly argue from an institutional standpoint that, um, you get to see a lot more different dynamics of VC and buyout, and just all the different nuances and the strategies and things of that nature. And while what we're doing is a little bit more refined, there is still nuance and strategies and what makes the VCs different. But of course, I'm certainly happy with the opportunity set that I have now, and that's my preference at the moment. Yeah.
Totally, totally. That's amazing to learn. So now you're supporting mostly female GPs at Cinefine, right? So is there any data that supports this thesis that, okay, female GPs are uh, better equipped to maybe produce better returns? So any data on that front that you can share?
There have been studies that show the benefit of female GPs and diverse teams in general. Um, they're helpful, but it's not something I'm looking to make a blanket statement to say that female GPs outperform male GPs. That's not something that I would do. What is true in our view is that women-led and co-led GPs are currently undervalued by many in the market, and we're looking to show that these firms, at a minimum, uh, can be value accretive as the other firms out there. So yeah.
Yeah, totally. And when you're looking at new managers, when they are pitching you to raise their funds, what are the key things you're looking for in them?
Yeah, there are a few traits that I find compelling. They're certainly a lot of things that you're going to be looking for, but from a qualitative standpoint, I would say preparedness. How well does the GP know their strategy and their market opportunity? Am I asking them questions that they never thought of? I, I, I hope that's not the case, but it sometimes is. I'm looking at their discipline. How convicted are they in their strategy? That includes sourcing and selecting. Are they easily swayed, or are they more high conviction, loosely held individuals? There certainly is a nuance there. And then finally, I would say, how authentic and sincere are they? What these the conversations that I have that are the easiest with these GPs are really authentic and sincere. They're very natural. It shows in having the conversation with them, and I see value in meeting with every GP and having that conversation to kind of illustrate all these data points that you don't necessarily see just in a pitch book.
Absolutely, completely agree. And you have seen a lot of game film, first at PSERS and now at Sinefine, on how GPs perform over time and what kind of trades are super important. So, uh, anything that you think is probably the most one or two important things that determine a GP's success over the long term?
Yeah, the backgrounds can certainly vary. The ones that I see typically succeed are the ones that have a high degree of discipline. They're generally free of bias. Uh, they're high conviction people who are always looking to improve. These are certainly qualitative traits that I think end up turning into quantitative traits as their track record grows.
Yeah, absolutely. And talking about while you were at PSERS as the portfolio manager, uh, what was the approach of investing there into VC asset class? So are like institutional investors taking a safer approach to VC investing, not investing in a fund once, only going for somewhat established fund three, fund four, or so on, right? Or maybe brand name funds, right? So how was that because you said earlier in the conversation that institutional investors are generally not interested in emerging managers or female led GPs, bringing up their funds. So what are institutional investors actually interested in, and at what point would they also be interested in female managers? Is that maybe somewhat later in the journey of that GP? Can institutional investor be a good target for them?
Yeah, there's a lot to unpack there. I mean, for just as a blanket statement as to what institutional investors are looking for, and at the end of the day, and I can only speak to the alternative investment side. Um, it sounds basic, but their key motivation is to generate alpha over the public markets. You certainly have to illustrate from a public market equivalent standpoint that they're outperforming, when there is quantitative data that historically they've outperformed what the public markets are generating. So, when you have that 2 and 20, um, management fee and carry perspective, it's very important that you're getting value for that 2 and 20. If you're getting a median return, from a peer market perspective, you may not be, and historically speaking, median performing GPs are not adding much to the PME, the public market equivalent. And so you have to, you know, ensure that you're supporting the top quartile managers. And so, one of the things that, when you're taking a look at established versus emerging managers, a lot of the decision making is quantitative versus qualitative data. And so when there are times of uncertainty, you're just going to lean back to more proven track records. And so the GPs that have that quantitative data, there is data out there to show that if you have a GP that is a top quartile performer, they're likely to be persistence in that performance going forward above median. And so you have a little bit better comfort there. On emerging manager basis, there is a chance for outperformance, but there is a chance for underperformance as well. You have a greater volatility of return there. So how do you meet enough emerging managers to ensure that you're selecting the top GPs? That's something that where I think fund of funds and consultants try to solve if you have an emerging manager mandate, because the bandwidth is just not as such, at the institutional level, that you're monitoring, you're reporting, you're approving capital calls and distributions, and you're doing all that, but then you're also trying to source new GPs. It's a bit much to handle. So, for instance, over the past 6 months, I've met over 200 GPs that are women-led and co-led. I wouldn't have been able to do that at my previous organization. I didn't have, there weren't enough hours in the day to be able to meet that many GPs. So what's often said is a flight to quality. I don't know that it's a flight to quality. It's really a flight to the known rather than um, maybe not having as much security in their qualitative measures when they're selecting GPs.
Absolutely. So the institutional investors do not have the time to kind of source those emerging GPs in a way. So are they like dependent on inbound deal flow on that front, that okay, we are only going to look at deals that come in, or is it only dependent on the folks that they already know and have known to perform, that those are the ones that are going to get the dollars?
Yeah, the from an emerging manager standpoint, I mean, there are conferences um, that are set up where you can meet emerging managers. So, typically the institutional investors that are attending those conferences have a program or have a willingness to invest in emerging managers. So, if you are an emerging manager, that would be the path of least resistance, and ensuring that you're talking to LPs that will actually allocate to emerging managers. You may not be a right fit, but they should be allocating to emerging managers. Um, and so, yeah, and oftentimes these relationships take a while to build. So, depending on the organization, they may not be a fund one type investor. They may wait for a fund two. Um, I think that sometimes there's a misnomer that you have to have realizations. I mean, as you know, in VC, realizations are likely going to take 7, 8, 9 years to occur. So by default, you're likely not an emerging manager by the time that you have realizations. You're going to be a fund four, depending on your deployment pace. So um, there are GPs that can find LPs that are willing to allocate to emerging managers. It's just making sure you're getting into the right forum to have those discussions.
Absolutely, completely agree on that. And since you have interacted with so many emerging managers, female GPs, is there any sort of advice you give them on the fundraising front? Because you've both been in the shoes of an institutional investor yourself, and now an LP at a fund of funds, right? So, what should be the target LPs or the target approach for emerging managers when they are sort of going out to raise their fund one, fund two? Anything you can advise them?
Um, yeah, it's really just ensuring that the LP that you're talking to, just making sure that you understand, that LP dynamic. Are they an LP that is likely to commit to a fund one? If not, maybe it's a more long-term discussion. You want to build that relationship. If you are a $50 million fund and you're talking to a $70 billion pension plan, you're likely not going to get a primary commitment because our check sizes are likely going to be too large for your fund. So depending on your concentration limit, um, you know, just ensure that you're targeting the LP at that proper time. I would say be open to having long-term discussions and building these relationships over time. Um, don't limit discussions to necessarily your current fundraise. Prioritize them, to LPs that could come in your current raise, but also be open to having these longer term discussions, because getting to know an LP over a long term and them becoming more familiar with you and your strategy, I think helps you later on to be able to attract LPs.
Absolutely, completely agree. So at Sinefine, do you have a mandate on fund structures that, okay, these are the fund structures that we like? Fund structures, as in, are we going to have a reserve strategy or not? Are we only going to invest at maybe seed stage funds, or someone is going to say, okay, we're going to go at Series B only, right? And is there a capacity for follow on, pro rata, and stuff like that? Those kind of things, right? So, any perspective on that?
Yeah, definitely. Um, I take all that into consideration. Yes, and I will definitely take all that into consideration when we're constructing our portfolio. Um, but no, we have no preference. I mean, that's part of what we're trying to illustrate, is that VC can win in any form. You can have a zero follow-on strategy, and there are some VCs that we really like that are reserving greater than 50%. Um, each one can win. Everybody has kind of an opinion as to what their favorite is. I am trying to be as unbiased and letting these strategies prove out. And I've seen both win. And I've seen the variance win. So there is an opportunity to invest in GPs that have a zero follow-on strategy, as well as ones that have 50% or greater. I think it's all really going down to the GP, how they're deploying that strategy, their conviction, how they're making that decision, and the reserve, follow-on investment, and things of that nature. But all those strategies can win in our view.
Absolutely. And any view on fund sizes that, okay, it's a fund one and it should be in this range for us to be interested. If it goes beyond this or maybe below this, we are not interested. So anything on that?
No, we're open on that front as well. Really, at the end of the day, it's going to come down to the GP to be able to um, support their thesis, support their strategy, and illustrate how it's going to report. A lot of it is going to be dependent on modeling, and understanding how they're constructing their portfolio, how they're selecting and sourcing their investments, and what they think is ultimately their rate of generating outsized returns. Are they more of a looking for a median? Are they saying, yeah, we're just going for, um, you know, there's a 2% unicorn uh, rate for GPs, and that's our target? Or do they think they can get a greater unicorn rate, and they can have that outperformance? So that's what you're looking for. There could be concentrated portfolios as well as really diversified portfolios. Again, I think VC can win in various ways.
Absolutely, completely agree. And can you share on what's your portfolio construction approach at Cinefine? Do you have some buckets that, okay, these are the sectors or maybe regions that we want to have GPs in? So tell us about that.
We are open to nearly every region. We see that the portfolio will likely be uh, more concentrated in the U.S., but we're certainly open to the other geographies as well. We don't have a mandate that we're only going to be one geography. At the end of the day, one of the lessons that I have learned, in the past, is that we're trying to generate the best returns possible. So um, we're not looking for European VCs that are outperforming the European market. They have to outperform VC, period. They have to be top quartile, period. And so that's the one thing I would say that is a caveat, is that we're open to any geography, but we're not looking to compromise return based on any factor, and that includes geography. Um, as far as
Right.
check sizes go, portfolio construction and allocation, um, we are looking to be uh, um, invested across sectors and industries. There will be an overweight, we suspect, in certain industries and sectors. I'm not necessarily prepared to talk about them now, but we will certainly target industries and sectors that have been proven in the past to be um, more value accretive than others.
Absolutely. And how do LPs look at down cycles? Like maybe we are right now in a down cycle, and maybe this is the normal and this is how it should be. But how do you react to these situations as an LP? Do you change your investment approach or maybe slow down the pace a bit? How do you do that?
Yeah, it's a good question, and it's something that I would strongly advise LPs to really take a look at that. What ends up happening and what has happened in recent times as well as in the GFC is that you have this dislocation, you have public markets come down, um, that institutional investor ends up over allocated to a certain asset class based on NAV and exposure. And so when that happens, they pull back and they say, well, we're going to invest less in VC because now our allocation has become lopsided. You have that denominator effect. When you do that, you're possibly over allocated to vintages that could be bad, in the GFC time period or, in the post-COVID world here. um, you could be over allocated to bad vintages. And then because of that denominator effect, and you pull back the commitments to VC, now you're going to end up being under allocated to possibly great vintages. And so you're really hurting yourself on both fronts. So the LPs that really outperform are the ones that are consistent in their pacing. They're going to be allocated to bad vintages, but that's okay because they're also going to be allocated from the same cost perspective um, to really good vintages. And so, in order to make up that possible lost return from the bad vintages, you really need to have that exposure to the really good vintages. So, that's what I would say is I would treat VC as an evergreen asset class. You don't think about DPI, you don't think about things of that nature. You're okay with just putting that money away and setting aside. You shouldn't use it as a liquidity management tool. It should be something that um, you're just looking for long-term value, and that's when those LPs succeed.
Right. Yeah, that's a very solid point there, that you need to be consistent in your approach, because since it's long term asset class, you don't know right now that which vintage is going to outperform. And if you don't allocate to that vintage, you're going to lose out. Or if you allocate to a vintage that's going to be bad, over allocate to a vintage that's bad, then that's going to hurt you more. So being consistent is going to be the safest and the best approach, right? In this.
Absolutely.
Uh, awesome. So now let's do the rapid fire round, wherein I'll ask you 5 quick questions about the investing you're doing at Sinefine, and you have to give 5 quick answers, right?
Sure.
Awesome. So the first one is, what are the sectors and regions you invest in?
All of them.
All of them.
So,
Awesome.
yeah, not yeah, wide open. So yeah, definitely all of them.
Great, great. What's the typical fund stage you're interested in?
All of them. So portfolio construction, we're trying to be an outsourced solution. Rapid fire question may not be a rapid fire answer, but the we want to be exposed to early, late, and growth equity for portfolio construction.
That's awesome. Is that also a portfolio construction approach that you're taking? That okay, we are going to also diversify across sectors. Is that also included in that?
No, absolutely.
Yeah.
You can think of us as being an outsourced solution um, that is wanting to promote gender diversity without having the risk of, certain sectors or industries or stages and or geographies and those things. We want to be a complete outsource solution where we're supporting gender equality, and you're allocating to women-led and co-led VC firms without having to worry about over concentration in certain sectors, industries, or geographies.
Awesome, awesome. What's the typical check size you put in?
We're looking at 3 check size target ranges, and it's
Hmm.
really going to be based on fund size and experience. Not quite prepared to discuss that in public forum, but there are certainly targets as far as our portfolio construction goes. There's going to be a higher concentration and number of GPs with larger ticket sizes, and that'll scale down based on experience and fund size.
Got it. Do you have a target ownership?
No, no, we don't have a target ownership of the GP commitment. I would say on the smaller side that's where it ends up becoming more of a LP GP discussion. We made target say 5-10% of a GP that is sub $75 million. And that's really going to be dependent on that partnership discussion, and they may only have bandwidth for, or they only want 5% as their highest, and that's something that we would have that discussion.
Right. Totally. Where can GPs get in touch in case there's a direct way?
Yeah, on LinkedIn. Please find me on LinkedIn, or you can send me an email at tony@sinefine.co.
Awesome. And LinkedIn is also the place where they can go and follow you, right? To keep
Correct.
updated. Awesome. Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, Tony. It's been a very insightful conversation. I wish you happy investing.
Thanks, Prashant. Appreciate you having me. Great questions, and really appreciate the what you're doing here with all the interviews, and it's really great being part of it.
Thank you. Thank you so much.